Yeah, you'll introduce me.
Good morning, Angel Viera. Welcome to SRES Networking Meetup Group today. We're so happy to have you here. And we're going to be talking about something that's new to me that I'm really anxious to learn about. So I'm going to have you go right ahead.
Okay, well, again, thank you very much, everyone, for having me. It's a pleasure being here. Julie, if there's any issues with the presentation on your end, let me know. So a little bit about me. My name is Angel Viera. My office is located in Montebello. I'm in Southern California, just outside of Los Angeles. I've been in the structured settlement industry for a little over 25 years. I've assisted two annuity companies set up their structured settlement programs, Transamerica and Pacific Life, way back in the day. The bulk of what we do in my office, we typically don't deal with the general public until recently. We help negotiate and settle litigated claims, including personal injury, wrongful death. So we've always dealt pretty much with litigants. And in that aspect, we deal with a tax-free growth annuity. That product has expanded where we also settle a variety of non-personal injury claims on a tax-deferred basis. That could include plaintiff attorney fees, construction defect, malpractice, divorce claims, and things of that nature. And so what's happened now is in that realm, there's got to be over 680 some, I think, annuity companies in the United States. The annuity companies that deal with structured settlements are less than 10. And within that realm, one of the annuity companies has expanded the program yet again with the structured installment sale. And that's what we're going to be talking about now. The structured installment sale is available in 49 states and Puerto Rico. It is currently not available in New York. Quick disclaimer, this material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. Please consult your own tax, legal, and accounting expert, as we do not offer tax advice. So what I'm going to be talking about now is the structured installment sale, and MetLife is the annuity company that stepped up. Actually, they introduced this product just before the pandemic. And before they could get it off the ground, the pandemic hit and things went sideways for everyone. And so we're helping MetLife reintroduce this product. It's pretty much only available to our very unique broker channel because we've had experience in dealing with these tax-related type issues in the past, so they've rolled this out to us. The structured installment sale is for properties that are sold that qualify under Internal Revenue Code section 453. And so what is an installment sale? The installment sale is when a seller sells a property, may get some monies up front initially at when that transaction concludes, and at least one payment after the tax year in which the sale occurs, right? So there's payments over time. Some of the properties that qualify for this structured installment sale include a primary residence, rental property, commercial property, land, it could be vacant land, and the sale of a small business. So when we're talking about the structured installment sale, we're talking about taking those sales proceeds and converting them into a guaranteed annuity income stream, and we'll get into a little bit more detail about that. So we've got the sales proceeds. We're going to convert all or just part of them into a guaranteed income stream. And so let's talk a little bit about what those annuity payments look like. The first annuity payment has to be payable within 1 year from that sales transaction. So it could be immediate, sale transaction is today. You want that first payment to start in 2 or 3 months, or you can push that first payment out as far as 1 year. The duration of the annuity payments can be anywhere from 2 years in length up to 40 years of guaranteed payments. The payments can be monthly, quarterly, semi-annual, or annual payments. The nice thing about these payments is that these payments, they're fixed and have no management fees. So once these payments have been set up, you just get that guaranteed payment over time. each annuity payment will consist of the return of bases, capital gains, and interest. So let's talk a little bit about tax tables. I've made quite a few presentations, and I've gotten some feedback and some questions. So I kind of put this table together to kind of remind everyone, when you're dealing with the sale of a property, some of the taxes that might be applicable might be federal capital gains tax, the federal net investment income tax, and the state capital gains tax. So what's important about that is that, and maybe in some of these sales transactions, is, you know, some folks understand this before they enter the transaction. Some sellers come to realize these taxes are applicable during the sales transaction. And then some people find out maybe after the fact and say, whoa, I didn't expect these taxes, or no one told me. So of course, we're always telling these folks, talk to your tax professional, you know, so you know what's going on. So one of the questions I typically get during these presentations is, hey, Angel, can you just kind of ballpark whatever that cost savings might be? And I can't. And why is that? Because the taxes are payable, are applicable. They take into consideration a seller's overall taxable income, which is going to relate to a specific tax bracket, right? So it's kind of on an individual basis. But here's what I wanted to point out. If we just looked at the first column, if somebody's single selling a property and we're looking at the federal capital gains tax tables, you'll see that if you have any capital gains in $0 to $47,000 total, right, overall taxable income, that means any other taxable income you have aside from the sale of your property, you'll be in the zero capital gains tax bracket. And then you've got these escalating tax brackets. So for example, when you get to 20%, it's applicable for any taxable income over $518,900. And so, you know, that's applicable when you start looking at all these other tax brackets. Those are the things to keep in mind. But what if we took some of those sales proceeds, put it into a tax deferred annuity, spread the payments over time, which means you're going to have a lower annual taxable income. So that allows you the possibility of being placed into a less expensive tax bracket, so you can save on some of those taxes. So how does this actually work? When you sell your property, you can decide, you know, out of that sales transaction, you're going to pull out a certain dollar amount cash up front. Maybe you've got a mortgage to pay, reverse mortgage to pay, bills, you need an emergency slush fund, whatever that is. Then the seller decides what's the net premium they want to defer or to place into an annuity. So again, what we do is we take part of those sales proceeds, we convert them into a guaranteed income stream, defer the payments over time, lower that taxable income in order to attempt to minimize any taxes. So how would that work? If you're looking at whatever this premium is, let's assume the house sells, I'm just going to use some round numbers. You sell your property for $1.5 million, you decide to pull out $500,000 and defer $1 million. Well, what if we gave the annuity company $1 million to annuitize? Now, these annuity payments are based on a rate of return that's going to hover just over 4%. So if we gave the annuity company $1 million, when I quoted this a couple months ago, it would generate $18,300 a month for 5 years guaranteed, right? So because there's an interest component, whatever dollar amount gets put into the annuity, the guaranteed payments, the payments over time are always going to be positive. So in scenario one, seller puts in $1 million, payments over 5 years, they're guaranteed a payout of $1.1 million. But I think what's also important is if you slide over to the right, look at what we've been able to do with that annual income. Instead of them taking that $1 million in cash and paying capital gains on it, we're able to annuitize it, spread it out over time, and drop that annual income to $220,000. And the way this works is because, again, each payment consists of the return of basis, capital gains, and interest. Technically, you're paying the capital gains in the years in which you're receiving the payment. You're receiving them in the future. And again, because every every seller is maybe in a unique position. It's just a matter of what it is they're trying to accomplish. So again, scenario 2, say $1 million, seller decides, hey, spread it out over 7 years. So it's going to be a lower monthly payment, $13,760, but the guaranteed payout's even higher, right? Because it's earning interest, paying it for a longer period of time. So it's generating a larger guaranteed payout. And again, if you look over to the right, we're able to reduce that annual income even further. So many times, the person's tax expert or CPA gets involved at some point, and then we start tailoring these payments to the seller's unique situation so we can maximize whatever those tax savings might be for them.
So the annual income, is that taxed at ordinary rates, or
So you're going to have a return of basis, which is technically tax-free. Part of it is going to be, you're going to pay capital gains on it. So it's whatever that applicable bracket you're falling into. And then the interest is going to be taxed as ordinary income, which I believe is about 25%.
Okay.
So some of the options that the structured installment sale provides, right? So again, it's eligible for primary residence. So for those that are looking to sell their primary residence and it exceeds their tax exclusion, this is something to keep in mind. Sellers are looking to downsize into a smaller home, maybe a single-story home. I mean, you've all seen all these scenarios, but I'll go through these. They're looking to sell and move out of state. Maybe grandma and or grandpa want to move to the other side of the country, be closer to the grandkids, whatever the situation may be. What I'm starting to see is people are looking to start diversifying some of these assets. They may own one or more rental properties, one or more 1031s, and now they want to sell that property, look for another option to defer capital gains, but kind of get rid of the maintenance and things of that nature that may be applicable. A recent scenario that's come up is for those folks, sellers, that may have an existing living trust. The living trust could be the payee, so the annuity payments would be payable to the payee. They'd also be the beneficiary if the payee or payees die before all those guaranteed payments are made. I also wanted to mention briefly the S&T. That's a special needs trust. In my 20 plus years of experience in the claims that I've had to settle, I bump into this every once in a while where I may have an individual that's on Medicaid. And so you may find yourself in a situation where somebody's looking to sell, but maybe they're on Medicaid. And then we have to be careful, right? Because if they come into a lot of money, they may get bumped from Medicaid. And maybe they need the medical component of Medicaid to treat for something. And if that's the case, we can address that. Typically what I would do on my other claims, or my claims that I would settle, we would put cash up front, would set up the annuity, and both the cash and the annuity payments go into the special needs trust, and the payee retains eligibility for those government benefits. So if there's ever a situation where somebody comes in and says, hey, I've got another scenario, let's talk about it. Let's see if that's something we can help you with. The next bullet point is actually, I've had this come up more than once, and at one of my booths where I had a realtor that had multiple properties brought his young adult daughter by and said, she's not interested in my business whatsoever. And I'm concerned because I've worked so hard to, have or obtain these properties, but I'm a little concerned. So I've got here, parents not confident adult children can manage their property or business. You can sell this now, lock in the guaranteed annuity payments or income, and then name your children as beneficiaries if and when the seller or sellers have passed away. Another option is, this is a very conservative annuity. It's fixed. It's got no management fees. And you heard me say earlier, the rate of return, high 3s, maybe mid 4s. Sometimes we get to 5% rate of return. Again, it's conservative. But if the seller's receiving a monthly income and they're not using that entire thing, well, they can have their financial planner take that excess and then reinvest those additional monies if they wanted to, and maybe some more aggressive financial products. But even if they lose money there, they'll never lose a dime using a fixed guaranteed annuity payment. Another option is to generate supplemental retirement income. Some of the folks I'm speaking with now, and a lot of them are over the age of 65, they either don't have a retirement plan, maybe they have a very small pension plan. So this is another way to generate additional income, guaranteed income for them. It allows them also to defer drawing on other types of retirement benefits. And the quick or the easiest example is Social Security benefits. The longer you defer those payments, they'll be larger when they get paid out in the future. But if you've got an annuity that's generating guaranteed income, you might be able to defer those payments into the future. Just as important or more important, I think, is paying recurring bills. So the annuity payment is going to give you guaranteed income. And we've all got recurring bills. It could be gas, groceries, utilities. I've got here various premiums. Those premiums could be health insurance premiums, auto premiums, life insurance premiums. You've got guaranteed income and you've got these fixed recurring bills, and now you can kind of match the two. And then also discretional spending. It can also generate guaranteed income to pay for things like home care, assisted living, or moving into a retirement home. And lastly, what I'll say about this, it can also help bridge the gap between the buyer's offer that may be less than what the seller's looking for. And an example of that, I'm going to back up just 1 second. You'll see here that these annuity payments, whatever annuity premium goes in, and depending on the duration that's chosen, it's going to generate a larger guaranteed payment over time. And sometimes, so maybe the seller has the option, hey, I'm looking for $1 million. The buyer's offering 900,000 and maybe can't come up with the difference. Well, let's take that 900,000, see what it'll do with an annuity. We'll have the tax deferral of capital gains. We'll have guaranteed income that's going to exceed that 900,000. Again, it's just another option to consider. So when comparing this tax deferral product with other products, some things to keep in mind. Again, it's eligible for a primary residence. These annuity payments are issued by a highly rated, regulated life insurance company. MetLife's been around for, I think, over 155 years. It has very good ratings, doesn't miss a payment on any of its annuities. And if anyone has any concerns, this is a fixed annuity. You could just Google how safe are fixed annuities. It's one of the most safe financial products that are out there. The nice thing about this, the seller gets to design the payment plan tailored to their immediate and future needs. I mean, we can run these quotes. We can run those benefit streams any way you like. So you not only maximize your tax deferral, but quite frankly, post selling of the property, what do you want to do in life? What are you trying to achieve? Do you want to try and open up another business on the side where maybe some of this guaranteed income will kind of help you push along? And if it doesn't work out, well, the income is always there. It just gives you other options, I believe. Again, the payments, because they're fixed, they're not subject to change. And because they are fixed, they're not affected by any market fluctuations. Market drops a ton, it's not going to affect these annuity payments. 2008 had that calamity had no effect on these fixed annuities. It's a competitive rate of return, just over 4% currently, but the internal rate of return is really going to be dependent on how long that duration of payments are. And some people say, yeah, but I can get better out in the market. You can. This is not a fix-all for everything. It's not for absolutely every scenario. But when you think that when you realize you get the tax deferral, some guaranteed income, and it allows you to do certain things, it's a pretty compelling option to consider. Once this annuity is set up, there are no ongoing management fees. Whatever that annuity payment is, you just get that payment. You're never going to get a management fee. There is an option to add a COLA, a cost of living adjustment on that. COLAs tend to be a little on the expensive side, and currently they're capped at 3%, but I can run those quotes for you as well to compare. You can compare something with a COLA, something without it. Again, the quotes are free, doesn't cost us anything. I'd be more than happy to run those quotes for you. One of the common questions we get is what happens if the sellers die before those guaranteed payments are made? So number one, the payments are guaranteed. So for example, if you chose a 10-year period and the sellers pass away in year 8, there's still 2 years of guaranteed payments that have to be redirected to whoever that beneficiary is, and it's payable in the same amount. Once the transaction is set up, and at that time, the sellers can decide, hey, if we pass away prematurely before all those guaranteed payments are made, we want a certain percentage, including 100% of any of those remaining payments to be commuted to present value and paid out in one single lump sum. That option to liquidate or to commute has to be chosen at the time of transaction. It cannot be chosen after the fact. So if there are going to be any limitations to this product, it's going to be that changes are not allowed under any circumstances. These are fixed annuities. They do not have cash value. You can't pull money out. You can't take a loan against it. You're just entitled to these guaranteed payments. And I say there's no liquidity. So, the sellers can't say midway, hey, I want to pull some money out. You can't pull money out of it, but I have that asterisk because the only time there is liquidity is if you chose that option above, that if the sellers pass away prematurely, if they chose the option to liquidate anywhere from 0 to 100%, the payments can be liquidated. These are scenarios that I've actually run across. Single female, age 75, selling her property. She wants the fixed income and to protect her principal. She just kept telling me, I've worked too hard. I've saved a lot. I at a minimum, don't lose any of my money. Number one. Number two, she was going to net about $750,000. She told me, I'm too nervous having that amount of cash that's liquid in my bank. So I'd rather take a nice chunk of that and have these guaranteed payments. I recently had a couple in their mid-70s sell their rental property in Florida, which has no state capital gains tax. And in working with their CPA, we designed those annuity payments and got them into the 0% capital gains tax bracket. They were very happy about that. In that scenario, the seller told the buyers, and I'll talk a little bit about, we need the buyer's cooperation. He was selling the property and he told the buyers, I'm only selling under these conditions. You have to agree to do the structured installment sale. I'm not paying that capital gains, the federal capital gains. Have another couple, females in the 70s, males 82. This is up north. And he says it's a 5-bedroom house. I'm 82 years old. Even if it's paid off, it's too big, it's too expensive just to maintain it. I want out. I need to start downsizing. I can't keep up with it. I had another single female 65 wants to sell her rental property. Her main concern, she liked the rental income, but she didn't like these, what she described as very restrictive laws, especially post-pandemic. And didn't like the interaction with her tenant so much. And she wound up taking early retirement. She has a very low pension. She thought she was stuck having to keep this rental property, but then realized, but if I sell it and I can get this guaranteed income, it'll help supplement that low pension payment. And then I rid myself of that rental property. Again, it's just another option. I currently have a person, single female, she's 95 years old. Her son is the living trust trustee. There's 4 other siblings. And so they're considering selling the rental property now and using that guaranteed income to help care for the mother. The expectation is that she may pass away maybe within the next 5 years, but there's already rumblings amongst the adult children as to who's going to get what. And their financial planner said, hey, but if I do this, I've got guaranteed payments. If and when she passes away, we can liquidate or commute 100% of the remaining payments. If the payee, if the trust is the payee, then the trust has to be the beneficiary. So that lump sum would be payable back into the living trust, and the trust can then disperse the funds equally to the surviving adult children. The mother wants to sell her home to her daughter, who she tells me has got a good head on her shoulders, and kind of wants to cash out the son who's not doing so well, and or generate guaranteed income payments for him that he can't then blow prematurely. So again, it's another option for the seller, but hey, how can we also help you post-settlement to set you up where you're really comfortable, and we can help address some of the needs you have. And then lastly, most recently, I had a single male, age 55. He's got 5 different properties. He's buying and selling commercial properties, and that's just one other example. To generate a quote, the quotes are always free. I generate these quotes. You're under no obligation, zero obligation to do anything. How soon can you run a quote? I can run quotes today, even if you're thinking of selling next year or next month, just to give you an idea as to how these things work, what the annuity looks like. You can start considering how it may or may not affect your taxes. You may want to talk to your tax person at that time. So this is the basic information I need to run a quote: the name of the seller, date of birth, type of property, the state that property is located in, the estimated dollar amount to defer in annuitize. And I say estimated because today you may think it's $1 million, and 3 months from now, for whatever reason, you may say, no, it's actually going to be $500,000 because there's other stuff I want to do with that cash. That's fine. The duration of the payments, 2 years, 5 years, 20 years. However, I will say the seller may not even know the duration until they actually see the annuity payments, and that's fine. So I can run various scenarios for the sellers to consider. And then what would help me is just to have the estimated property sale date. Are you thinking of selling? Is it for sale now? You want to sell it by year end, or you just want to consider selling it sometime into the future? The timing of the transaction, it's always best to get me involved as early as possible so we can start discussing either that unique scenario you might be in, answer any questions you may have. And so you'll have these scenarios so the sellers can discuss this with their legal or tax experts. If it's something that the seller really wants, best thing to do is advise any potential buyer as soon as possible that the seller is selling under these conditions, and we're going to be looking to the buyer to cooperate with us to fill out whatever required documentation needs to be done. So again, the buyer and the seller both have to complete certain documentation. And the way we keep these payments as tax deferred is typically escrow will fund the annuity directly, so there's no constructive receipt. And we'll coordinate that with escrow as well. So what happens is the money is going to escrow. The seller says, hey, cut me a check for X, pay all these other bills. And whatever that balance is gets payable directly to the annuity company. And we provide address, tax numbers, and things of that nature. So there's no constructive receipt. At the end of the transaction, the buyer and the seller go their own separate ways. I added here that there's no lien on the property. I have been asked, so, does the annuity company, do they come out? Do they look at the property? What's their take on the property? They're not a party to the sales transaction. They don't need to see the property. There's no lien on the property. The buyer buys the property for whatever dollar amount the buyer and seller agreed to. The seller takes whatever cash they want, and then they look directly to the annuity companies for those future guaranteed payments. And then at the end of the day, once this whole transaction has gone through, a few weeks later, the annuity company will issue an annuity contract issued to the seller or sellers, and it'll have their name on it, and it'll state specifically what those annuity payments are going to be. And that's it for me, everyone. I want to thank you very much for your time. Again,
thank you, Julie, for having your guest.
I'm sorry?
I was saying thank you, Julie, for having your guest. Very good information. Are you in the office, Julie?
Yeah.
Oh, maybe I'll come by and say hi.
Yeah. Good idea.
Okay, so Angel, a couple of questions.
Yeah, go ahead.
I don't suppose MetLife's doing this as a charity. So how are they getting paid? How much are they getting paid? And when is it getting paid?
Can you clarify as to who's getting paid and
Well, for
what is
the
getting paid?
annuity, the MetLife, how are they making their money on this?
Well, and again, if you know, that's actually an excellent question. So annuity companies, the way they make their money, like in this case, it's a fixed annuity. You're gonna, in my example, you give them $1 million, and remember, they're only issuing certain payments over time. So what are they doing with that? The rest of that cash, they're reinvesting it that entire time. So even though they're paying these sellers a larger amount over time, they're still making they're still making a profit by reinvesting that money. And if by chance they hit a bump in the road and they're losing money contractually, they're still obligated to make whatever payments were agreed to. But that's generally how annuity companies operate.
And will this technique work for foreign properties?
It will not.
Okay.
It will not. Only 49 states and Puerto Rico.
So which state is
New
left
York.
out of there?
New York.
Yeah.
And
So
that's not to
Florida.
say it's
Okay,
not
So
going
I
to
got
be.
a question.
Yes.
Angel, so I sell my house in California, put it in this trust or whatever, and then I buy one in Florida. So I beat the gains in California, right? And then they don't have the gains in Florida.
Well, so it's not going into any kind of trust. So whenever you sell your property here, that will dictate, you will state how much cash up front you want. And maybe you use that cash to buy something in Florida. But in that same transaction, it's going to, let's assume it's going to give you 500,000 in cash, and it's going to give $1 million to MetLife to place into that annuity. And then that transaction is done. What you do in Florida is a whole separate transaction that has nothing to do with the annuity company.
Keep in mind that this is you're putting your funds into an annuity, not into a trust. There's another
That's correct.
vehicle for doing the exchange into a trust, but this is into an annuity.
Yeah, and I'm so glad you mentioned that. This is not a 1031. It's not a deferred sales trust. It's not a Delaware statutory. It's none of that. This is literally the way I explained it. Money goes into a conservative fixed annuity. It's going to generate payments over time. There's no guessing as to who's involved and whatnot. I mean, we're dealing with a conservative, highly reputable life insurance company.
The reason I like it so much is that it is able to be used for personal residence, while most of these other tools are not. So that's kind of the ace in the hole with this.
Yeah, and that's, again, you know, I pride myself in trying to just get the information out, letting folks know there's another option. And again, I mean, half the people that come to me maybe it's helped educate them, and maybe help them realize that that other product was actually better for them. That's fine. You know, it's a matter of just letting people know this product is out there, it exists. And it might be something you might consider, but you know, most of us that have bought properties 25, 30 years ago, we're sitting on a ton of equity. In many cases, we want to move. And I've had, especially for some of the inquiries, folks that are in their mid-70s, they would like another option, but they feel like they've worked too hard, and that capital gains tax, they're just going to sit where they're at. They're like, nope, not going to do it. That's too much money. Exactly. Not only that, but then what happens after the fact? And so from my perspective, you know, I'm not a realtor. I don't sell real estate. But with the folks I've been dealing with and settling these claims, and these are typically injured parties and stuff, it's a matter of what are your needs? What are you trying to accomplish? And let's see if we can create a plan or a program that allows you to sell, defer your taxes, but helps you, you know, to get on with your life. And maybe it's paying for that assisted living facility that they really, really love. You know, it's just a variety of things, but it is another option. And again, yeah, the fact that it's eligible for a primary residence, I think now gives quite a few folks another option.
So I have an observation. This is, I think you had mentioned that this is a relatively new offering as an annuity.
That is correct. So MetLife launched it just before the pandemic, and then the world came to a standstill, so it kind of hesitated. I will tell you that in our same niche channel, Allstate and Prudential launched the same product maybe 20 years ago, but there wasn't really a need. People weren't really jumping on it. Property values, of course, were a lot cheaper back then. Capital gains was an issue, but not as big as an issue as it is today. So those products kind of went by the wayside. So MetLife picked it up and ran with it. And if anyone wants, and maybe Julie, they can go through you. I have a white paper from MetLife, and MetLife's not going to introduce something they're not comfortable with. So they've done their due diligence. They've got their private letter rulings. They everything they need. So, and during these transactions, if an attorney has any questions, CPA, both either on the buyer or the seller side, ask your question. Let's go get some answers. So.
Exactly. And this goes exactly directly to especially what we do as SRES is we preserve, protect, and otherwise leverage our family's real estate asset. And this is another tool directly connected to that. I have another question. So during a transaction, when a seller is selling their home, what exactly is it that the buyer has to cooperate with, and how?
Excellent question. So remember, all of this is under Internal Revenue Code section 453.
Yeah.
So whatever whatever qualifies under this section, we can do here. So technically what we're doing, it's still an installment sale, but your typical installment sale would be, hey, I'm the buyer. I'm going to give you $500,000 today and $200,000 every year for the next 5 years or whatever. That's your typical installment sale. And the seller in that scenario pays capital gains in the years in which they receive those payments, right? In this case, buyer and seller, they're going to have their own negotiations going on. They agreed to a dollar amount. They agreed to a selling price of $1.5 million. When I run those quotes and the seller agrees, this is the payment stream I want, technically, the only way this works, to make sure we're meeting the requirements of the Internal Revenue Code, is that we say, hey, buyer, you're still buying for 1.5, but we're going to put all this money into escrow. These annuity payments, technically, you're making them to the seller, but part of that transaction is, here are the annuity payments. The seller assigns that obligation to the annuity company. The annuity assumes that obligation to make those periodic payments, and that allows us to qualify under Internal Revenue Code section 453. So the seller, what is the seller doing? They're assigning those future obligations to the annuity company, who's assuming that liability.
Don't forget that in a straight installment sale, you are basically a lender. You're loaning the balance of the purchase to the sellers, and you have to do your due diligence to make sure they don't default on it, or any other problems that you might have in becoming a lender. And with this installment, the settlement is going to shift that to the annuity, so
Absolutely.
that you no longer have to take that risk anymore.
So this is seller financing, and the buyer comes in as a cash buyer.
That's an installment sale.
Yeah, so I mean, I'm just learning. I'm just learning. I don't know what I know about installment sales on court ordered awards.
Yeah, so to Skip's point, technically we're replacing if you think of installment sale, technically what we're doing is we're replacing that buyer with MetLife, and MetLife takes on that obligation going forward. So it's pretty straightforward. So I know when you're hearing about it for the first time, you start thinking all these different things. I've had people say, what's the buyer's lender going to say? They've got nothing to do with this transaction whatsoever. I mean, the buyer buys, the seller sells. So MetLife are kind of coming in on the back end, but we need the buyer to assign those obligations, those future payment obligations. Otherwise, it doesn't qualify under internal, as an installment sale.
So the buyer can have a lender and then the lender knows about all this? Is that how it works?
Well, yeah, but the lender has nothing to do with the transaction. Right? The buyer's going to buy for 1.5 million. His lender's going to fund it. And we're just setting up annuity payments kind of on the back end. And escrow's funding the annuity. It's got nothing to do with the lender, the buyer's lender.
Okay, so because the only thing I'm tripping up on is if my buyer client went to their lender and said, oh, this is going to be an installment sale, is the lender going to know what the hell we're talking about?
Yeah, well, number one, it's not really an installment sale in the basic definition of it. The buyer and his lender are still going to go through the transaction the way they normally would. But again, if anyone in this process has a question, we'll flush it out. We'll get them on the phone and we'll just talk right through it. And the reality is, on occasion, somebody may still be uncomfortable with it. Look, we're just presenting an option. It's we're not forcing anything on anyone. So if all the parties get together and they play ball, like my case in Florida, and the buyer never asked a question. He's like, I'm not worried about MetLife at all. As long as I don't have to pay a penny more, I'll take it. And the seller was happy because the CPA got him into a zero tax bracket. That's a lot more difficult in California because prices are what prices are. But at least it's an option to consider before pulling the trigger. And what most, if not all, tax people or tax experts will tell you, I wish you talked to me before you pull the trigger on that thing, because now we're having to deal with something after the fact. So I like giving options. Talk to your tax folks, your experts. If they have any questions, have them call me directly and we can walk through this.
Well, and that's exactly goes to my point, and why I'm asking, because we'll go out there and talk to people about it and our professional affiliates, and they don't know what we're talking about either.
Yeah. So again, I mean, it's only available to our unique broker channel. So even your standard, maybe your standard life insurance agent, they won't know about it. And if they go to MetLife directly, MetLife is going to send them back to people like myself that are in that channel and have had the training to be able to promote it. Mm-hmm. And if anyone has any questions, you can literally type in MetLife Structured Installment Sale. You can go to their website directly. It's going to say, if you have any questions, contact us. They'll explain the product, but if you're interested in it, they're going to send you right back to people like myself that are actually licensed by the state to go ahead and offer the product. Yeah.
Awesome.
And there's good videos. I've got videos, white paper, facts, information. So whatever anyone needs, we can provide that information.
Yeah.
I do have some questions, and I'm in a situation right now with a property that's been very, very difficult to sell. It's in Oakland, and since all this hoopaloo has happened in Oakland, it's made it even more difficult. So, and our contract is going to expire in a month. So the other agent that I'm working with, we're trying to come up with everything we possibly can to get this thing under contract. So your slide doesn't have your information. I wanted to take a photograph of it and certainly get a hold of you to see if there's something we can do to save this transaction and get it sold. Because she doesn't want to lower the price. We've had a hard time. It's been inching down. And now with all this stuff that's going on, she has equity. Okay. But she thinks she, of course, is worth more than what it's supposedly is worth. So we're just trying to find out different options that we can use in order to sell. Now I think she would like it.
Oh, I think your mic went out.
Angel, maybe you could put your first slide on with your contact information.
Okay.
Yeah, it's in the handout too, or the email.
Yeah.
Or whatever.
Yeah, I can call you too on it.
Yes, Michelin, his information is right here on page 1 of the bulletin.
Got it. Taking a picture so I can send it to Steve.
Okay.
So, and your mic cut out, so you could repeat your question.
Oh, basically, if this would work in terms of the sale that we currently have, this listing that we currently have, in terms of, say if she stayed at the price, well, I think, say somebody, we did only have one offer the 6 months that we've had it on the market.
Okay,
And if something of this nature could work with her getting the income, it's off her hands. And it sounds like she would be getting a guaranteed income for however many years.
correct,
MetLife would then be in the picture. The new buyer would have title to the property,
correct.
and life is great.
And life is great. There's no lien on the property. It's just an annuity transaction. It's really what it is. And even if your seller won't budge, even if we ran the numbers, and she might be able to see, even if you budged a little bit, you're going to make it up on the back end. Either
That's what I'm getting at.
guaranteed payout and or the tax deferral may more than make up for that difference.
Thank you.
Yes, yeah.
Okay,
So,
great.
yeah. Contact me, whenever you like. We'll walk through that specific scenario.
Okay.
These annuity companies have their own underwriting guidelines. And so one of the guidelines one of the guidelines with MetLife is the payments have to start before the sellers are under the age of 85, right? But I have other products, annuity products that are looking at the same option that I might have. So if I typically lead with MetLife because it's got the name recognition. But if we run into a scenario that's a little different, like in the case in my example of the 95-year-old, there is another annuity company that just told me last Tuesday they'll take it. And so I've got some options, and I'm hoping and I'm thinking in the next couple of years that we'll have other players come into this market as well.
So you're
Okay.
basically a broker and not tethered to one particular.
That is correct. In my regular job as a structured settlement consultant, I represent 8 annuity companies. And what I do is I settle my claim. I go out to whoever provides the best bang for the buck, whatever monies we're putting in there, to maximize whatever the payout's going to be for the payees. In this particular case, technically, it's only MetLife that's got that product. But and you'll see how conservative they are. They've been around 150 years. On occasion, I'll still have someone say, "Yeah, what if they go bankrupt?" Well, they've got to go bankrupt in 5 years or 10 years. I also have access to U.S. Treasuries, so that is an option I have today. Rate of return is going to be more conservative still. And as like I said, some of these other folks that are looking at this space may provide us with additional options in the near future.
Gotcha. Amazing.
Any other questions?
Oh, are your slides available?
They can be, yeah. And what I did, Julie, is I updated one. I added one more slide this morning. I'll PDF it to you 5 minutes after we're done here. Yeah,
Great.
and I can do this again if you have a group of folks, if you want this presentation for your office, however you guys want it. I show up in person sometimes. I'll do it on Zoom, whatever works for anyone. And if anyone has any questions at any time, feel free to reach out.
So I'm thinking this would be a fabulous subject for a consumer-facing seminar. Some of us can create a group of people that are in our databases that we might think that would benefit from this kind of product, and then invite them to come learn about it.
Sure.
We do this
Sure.
thing on Tuesdays, cake and coffee office hours. So, and we invite homeowners in our databases to come learn about something. So this will be a great subject. And it is brand new. So for us, walking around talking to our colleagues, our affiliate colleagues, never mind the homeowners, we got to explain this. So us having a really good understanding of it, and at least just a good elevator speech to introduce the subject and then bring you in as the expert is a really good opportunity, I think.
Yeah, I mean, my hope is that in the near future, again, it's just a matter of getting the information out. You know, I like doing my best to educate folks. So when somebody's thinking of a 1031 or a DST, that, you know, this will be second nature to folks. Oh, what about the structured installments? In other words, we have options. So which one best fits that unique situation? Because, and I don't downplay any of the other products. All these products have a place. It's just a matter of what's best for the sellers. What are they trying to accomplish? I had one recently that said, can I do a split? Can I do a 1031 for a portion of it and then do your structured installment sale? And I said, that's an excellent question. So I ran it up with the underwriters, and they're kind of looking at it now. So again, if there's any situations you can think of, or you know, there's so many unique situations. That's kind of what I love about this as well. I'm talking to folks all the time. Something is always going on. Let's talk about it and see if this is a good fit or not.
I'm going to say hi to Cardwell. Cardwell comes in from New Jersey. And so that is completely like a whole nother market. And did anything connect with you on what you see out there?
Well, I came in late.
That's okay.
Yeah, I came in late, so I missed most of the presentation, to be honest. I'm gonna have to catch him the next time around, honestly.
Well, this is recorded.
Oh, okay, good. Good.
So being out there in New Jersey and in your market is pretty similar to, so Angel's in the LA area in Montebello, and then we're in Silicon Valley, San Jose. So we have that market, right? Where we have our senior homeowners have a significant equity position to where they need to make these kinds of decisions about how they're going to deal with proceeds from a sale of their property. And this particular product connects with the primary residence. So, which is a bonus. I mean, because they're so used to not having things that they can do that with their primary residence to defer and minimize their capital gains liability.
Okay.
And then this is a brand new, it's brand new, basically just a couple of years old option from a significantly important annuity provider.
Right.
Am I saying all that pretty good, Angel?
Yes, Julie. Yes, thank you, by the way.
Is it like a Heckham?
No,
No. Okay.
no.
Like I said, I came in real late, so
Watch
I'm
the
gonna
recording.
Yeah.
Will do.
I just wanted to point out that Cardwell's in the New Jersey market, and it is pretty similar to our markets, Angel, and that in these kinds of markets, when we have our homeowners are either 100% equity or at least over 75% equity, and they do have over $1 million that they could experience in a net proceeds, and they do need to make decisions about that. So
and that's what I'm finding as well. And actually, with some of these sellers, they're a little not only conservative, but quite frankly, they're afraid. They want to move,
the biggest
but
thing.
that's too much money to be sitting either in a bank by itself, or the next question becomes, what am I going to do with all that money? I don't know what to do with it. You know, I do want to move to another state that's cheaper. And out here in California, you know, we have a ton of people going down to Mexico buying second homes. Well, sell your rental or empty land in California, generate some income, buy your property somewhere else in the, in the world or what have you. But again, it's just more options. But some of these older folks, it's too much money to just sit around, right? It concerns them.
And I would say to my senior homeowner, if I was just talking about it on the outset, to not be afraid of it not being liquid. There is an exit that they can create in order to mitigate that a little bit. But compared with the other options, they can make good decisions about it, even having said that, you know, knowing that it's not as liquid as other options.
Yeah, and it's not liquid at all. So like one of the things and one of the qualifying things, because the annuity company looks at these on a case-by-case basis, hence some of the questions that I have before I run these quotes. But one of them is, do you have enough liquid assets? You know, if you're 70 years old and all your money's tied up in this annuity, there's a very good chance they're not going to approve it, because they know for a fact you need to have some cash liquid assets in the event there's a bump in the road, because we can't liquidate any part of this annuity. So from Met's perspective, they're very conservative. They're just trying to do the right thing and not have something bad go sideways. But the most we can do is educate folks, let them know it's not liquid, and maybe they can find liquid assets somewhere else, or if they can't, maybe it's not a good fit.
Well, that's good to know. So what's like a DTI on that?
And what is that?
Debt to income. So if it's not liquid and MetLife wants them to have a certain amount of net assets that are liquid so that they can.
I don't think they'll get into that much detail.
Yeah.
Number one, they're going to have them sign documentation that says you understand clearly you cannot liquidate these annuity payments. We want to make sure that you're comfortable with. And one of the questions may be how much liquid assets do you have? But that's more of an internal call they make, or maybe their underwriters are taking a look at it, but there's no set formula.
Okay, well, we would want to know, because I'm going to tell them that. My homeowner.
Yeah, I'm not sure they would give me a number or a percentage. What they just tell me now is run the scenario by us and we'll take a look at it. I've not had them turn anything down.
Yeah, I think you're getting too specific, Julie. You know,
it's a great question. No, it's a very good question, you know.
Yeah, they're gonna, of course, MetLife is gonna say, you understand.
Yeah.
Well, if you want to
We're
learn
on the
about
other
these
side of that.
things, if you want to
ahead.
learn about these things, learn about annuities in general, and then you'll have a better idea of how this works, you know, with the structured settlement. But
Yeah.
the annuity is the key to this whole thing, and you need to have some kind of a working knowledge on how annuities work, what they do, what they don't do, limitations, etc.
Yeah, and I
Yes,
think the big
thank
issue is, especially for our older sellers, we just want to make sure they're taken care of. They understand what transaction they may be getting into. And, you know, as all of us get older, the expenses go up. We think they're going to go down, but, you know, sometimes they go up. Something happens and you need access to cash or what have you. But on the upside, like I said, it's guaranteed income that allows you to either pay your health insurance premiums. It can help take care of some of these folks, kind of almost looking at it for that demographic as a retirement option, right? And maybe it's a way to diversify, because you've got 3 rental properties, you sold one. Maybe it's one you like, maybe it's one you don't like. You don't like those tenants. Now you have guaranteed income. And if the other tenants don't pay, you still got this base of guaranteed income. So it's just a way of, I think, diversifying some of those assets. And for those that are looking, as in my example, where they have a 5-bedroom, 4-bathroom house, the 82-year-old just told me, I can't keep up with it. I'm spending too much money hiring people to help me maintain it. This doesn't make any sense anymore. And so, right, just another option.
Anybody else have any questions?
Sorry, I got bumped off. Yeah. Yeah, but I like what you were saying. I guess I can run it by Julie or something.
Yeah,
Katie's-
I'm here.
Katie-
Anything you need, let me know.
Okay.
Oh, for sure. All righty. Well, if nobody else has any questions, I'm gonna stop the recording, and thank you very much.